Dividend growth investing is great, but with the amounts that Apple, Visa or Microsoft pay, you would need a massive portfolio to be able to live off your dividends, and it takes years and years to build up any meaningful dividend income. Investors who do live off their dividends often have portfolios over $1 million, and usually have been investing for decades. But what if, like me, you have dreams of retiring early in life? At least before you turn 40 or 45. You don't have the resources to save and invest over $1 million. If you want to live off dividends without waiting decades and decades and amassing a huge portfolio, there's a different strategy you can follow in order to get there much faster. It is investing for dividend income now rather than for income later. In other words, income investing. Now, don't get me wrong, I am a dividend growth investor myself. So as a dividend investor you have two options. 1. Invest in companies that pay very little dividends now, but increase them faster so you will get more dividends in a few decades. Or 2. You invest in companies that pay out higher dividends now, but increase them at a slower pace. Let me give you two examples to illustrate the point. Let's assume you have $5,000 to invest. If you take a company like Visa, which I ironically just bought, but more on that later, they pay out 1.28 per share per year. This translates to a dividend yield or return of about 0.6%. At the current price of $215, you would be able to buy 5,000 divided by 215 is 23.2 shares. So if you multiply the number of shares, 23.2, times the annual dividend payout, $1.28, you would get less than $30, 29.7 per year. If we divide that by 12 to get the monthly payout, you get about 2.50 in dividends per month. Not really an amount you can live off, right? In fact, if you want to live off dividends and let's say you need $4,100 per month, you would need $8.2 million invested in Visa to get to that point. I don't know about you, but I don't think I can save that up. And now, let's take an example of a company that pays you high dividends. It was included in my recent list of undervalued dividend stocks, and that would be Enbridge, which is a pipeline company. Enbridge pays us $2.63 per year and is currently priced at $35.44, which translates to a dividend yield or return of about 7.4%. Again, we take the $5,000 and invest it in Enbridge. Now, we get about 141 shares of Enbridge, which pays us 141 times $2.63, which is almost $371 per year. Dividing it by 12 to get the monthly payout is almost $31 per month. That would be enough to have a small family dinner at McDonald's, but that's about it. But hold on, we're getting there. So this time we only need 132 times the investment of $5,000 to get $4,100 in dividends per month, which translates to 5,000 times 132 is $660,000. Yes, of course, that is still a lot of money. So we have not solved the puzzle yet on how to retire early with dividend investing. But there's a little trick to help us to get to our goal faster. And of course, we don't need to come up with the money straight away. Let's use a time horizon of 10 to 15 years. The key parts of dividend growth investing are that 1. The dividends tend to increase every year. This is not a guarantee. And 2. That you reinvest your dividends until you need them for retirement. The reinvesting and dividend increases create what is called a compounding or snowball effect. I have talked about the compounding effect extensively before, but let me show you. In the case of Enbridge, we take a 7.5% starting yield, an annual dividend growth rate of 3%, which is very low considering a 5-year growth rate of 10% for Enbridge. We invest about $850 per month, and in about 15 years you will be earning more than $4,100 per month, and you would only have to invest $850 per month for a total investment of $155,000 over those 15 years. If you are able to invest a little bit more every month at $1,000, you even get there in 14 years. Now, there are two problems with investing in dividend stocks purely for their income. The first one is the lack of price growth or price appreciation. Again, back to Enbridge. Over 10 years, they have only increased about 11% in price. If we compare that to the price growth of Visa over that same 10-year period, we see a price increase of 1,050%, almost tenfold. So it is definitely a big sacrifice to focus on dividend income instead of dividend growth investing. But there's also a solution for this. I will get back to that at the end of the video. The second problem is protecting yourself against the hidden monster that is always there. inflation, or loss of pricing power due to the increase in prices of consumer goods. When we focus more on dividend income now, we make the implicit choice to pick stocks that have lower dividend growth as a consequence. And dividend increases help us stay ahead of inflation. The solution for this is to focus on dividend stocks that are beaten down right now, so on sale or otherwise called undervalued, but still have good dividend growth rates. The reason I picked Enbridge as an example is because this company actually has both. It has a high dividend yield and a very nice dividend increase normally. Their 5-year average is 10%. So why don't we just pick the highest yielding dividend stocks out there if we want to invest for income so we can get there even faster? Well, if we do that, we end up getting burned by companies cutting their dividend left and right. Because what you have to understand is that the price and the dividend yield, the interest, have an inverse relationship. If the price goes down, the dividend yield goes up, because we are getting paid in dollars, not in yield. So the dividend payout stays constant, unless increased or decreased. And the return you get, the yield, goes up or down depending on the price. The price goes down because people fear the company is facing certain risks, meaning the company might make less profits. So the dividend yield goes up as a result. And if a company makes less profits, there's less money left over to pay out the dividends, which could mean the dividend payout is decreased or cut completely. A way to check that is by looking at what is called the payout ratio, or the ratio of profits paid out in dividends. If that ratio gets too high, it is more likely a dividend is cut. So there's a balance between risk and reward. There's also one very important requirement to keep in mind, to have a successful path towards your freedom with dividend income. But first, a bit about this channel. I'm Tom from the Dividend Attitude Show. On this channel I make in-depth videos about dividend stocks, battles between two dividend stocks, portfolio updates and general knowledge videos like this one. Now, back to the important requirement to make investing for immediate income a success. You have to pick quality companies and not just go for the highest yield possible. I could and have dedicated entire videos on picking quality companies, but here are some starting pointers to look out for in a company. Increasing sales or revenue, increasing profits or net income, enough profits or cash flow to well cover the dividends, the payout ratio, low debt, a sustainable competitive advantage or moat, and quality and shareholder-friendly management. If you want to get some ideas for quality companies, I have a playlist on stock battles in which I outline two companies in the same industry to see how they compare. The playlist is now suggested in the top right corner. Now, at the beginning of the video I mentioned that I did recently invest in Visa. After you have heard what I just told you, you might be wondering why on earth would you buy Visa if you want to live the dream and retire early? To me, it is about solving a puzzle. A puzzle where I want high immediate dividend income, but also enough dividend growth to keep beating inflation. That puzzle is solved by looking at my portfolio as a whole, and all the moving parts within my portfolio. On one hand, I have higher dividend income plays like Omega Healthcare Investors, ticker OHI, which gives me a 10% yield on cost, but very little dividend growth. On the other hand, I have companies with higher dividend increases but lower immediate dividend income, such as Visa, but also companies that have both, such as T. Rowe Price, ticker TRO, Williams-Sonoma, ticker WSM, or General Dynamics, ticker GD. The higher dividend income companies help me now, and the higher dividend growth companies, like Visa, help me later in life. Let me be very clear, there's no such thing as a free lunch. Companies with higher yields typically bear more risk. But other than that, investing for immediate income can get you to your desired life faster, and the added benefit is that you start to see significant results a lot faster as well. And Enbridge is definitely not the only quality company which has a higher yield right now. If you want to see how I invest in dividend companies, what my portfolio looks like, and so on, you can check out my portfolio updates, which is now suggested in the top right corner. YouTube thinks you like this video next, so enjoy it. Until next time, bye bye.